What if I told you that every financial crisis you've ever studied, from the Great Depression of 1929 to the Great Recession of 2008, were just tremors before the real earthquake? What if the next collapse won't just be a market correction, but a fundamental reset of the entire global financial system? This isn't speculation. It's the mathematical certainty of a problem so vast, it's almost impossible to comprehend. It's the $300 trillion problem. This isn't a headline you'll see on the evening news. It's a figure that represents the total sum of global debt, a colossal weight of leverage that underpins every transaction, every mortgage, every pension fund, and every government promise made for the last 50 years. Most people hear a number like that and dismiss it as an abstraction. But it's not an abstraction. It's a very real claim on all future human productivity. A shadow that has been silently growing in the background while markets hit all-time highs. This isn't a random anomaly or a simple mistake in policy. It is the predictable, systemic outcome of a pattern that is repeated throughout history. A pattern where stability is manufactured with cheap credit, where every crisis is solved by creating even more debt, pushing the final reckoning further down the road. But we have now reached the end of that road. The mechanisms that built this mountain of obligation are now the very instruments of its inevitable collapse. The comfortable illusion of safety and prosperity that central banks and politicians have carefully constructed is about to shatter. They want you to believe the system is stable. They need you to believe it. But in the next few minutes, I'm going to show you the hidden architecture of this crisis. I'll explain why this $300 trillion colossus was built, how it operates, and why its unraveling is not a matter of if, but when. You are about to confront a reality you've been shielded from. Let's be clear about what this $300 trillion problem actually is. It's not a temporary market downturn or another housing bubble. It's something far more pervasive, an invisible architecture of obligation that underpins our entire global system. It is the aggregate of every single debt on the planet. Every government bond issued to fund a deficit. Every corporate loan taken to finance a stock buyback. Every home mortgage. Every student loan. Every credit card balance, all compiled into one incomprehensible sum, $300 trillion. Try to visualize it. If you stacked $300 trillion in $100 bills, the pile would reach past the International Space Station. If you started a timer at the dawn of human civilization and counted $1 every single second, you still wouldn't have reached $300 trillion today. This isn't just accounting, it's a physical weight on our future. Let's break down this colossus. Roughly 1/3 is government debt, sovereign nations borrowing with a reckless abandon that makes a casino gambler look prudent. Another third is corporate debt, much of it taken on not for productive investment, but for financial engineering that benefits executives and shareholders at the expense of long-term stability. The final third is household debt, the mortgages and credit lines that maintain a fragile illusion of prosperity for billions of people. But here's the core concept you must understand. Debt is not wealth. It is the opposite of wealth. Every single dollar of that $300 trillion is a binding claim on future human labor. It's a promise that tomorrow's earnings are already spent. We haven't created prosperity. We've simply pulled it forward from the future, leaving a void for the next generation to fill. It is a tax on unborn generations. Historically, this situation is in a category of its own. Even after the massive expenditures of World War II, global debt, to GDP, was a fraction of what it is today. Before the year 2000, the total figure was less than $100 trillion. In just over 2 decades, it has tripled. This is exponential growth, a hallmark of every unsustainable system in history, from bacteria in a petri dish to a nuclear chain reaction. The problem is no longer just the size of the debt, but the speed at which it compounds. The system now requires more and more new debt just to service the interest on the old debt. It's a financial black hole, pulling in capital, stifling real growth, and growing ever more powerful. This isn't a problem we can inflate or innovate our way out of. The debt is now expanding faster than the underlying global economy that's supposed to support it. It's a mathematical certainty, a runaway train with no brakes, and the track ends at a cliff. This $300 trillion colossus didn't appear overnight. It wasn't an accident. It was built, brick by brick, decision by decision, over the last 50 years. The foundation was laid on August 15, 1971. On that day, President Nixon severed the final link between the US dollar and gold. This wasn't just a technical policy change. It was the moment the world's financial system was unchained from physical reality. For centuries, money had been anchored to something tangible. A dollar was a claim on a fixed amount of gold held in a vault. This imposed a natural discipline on governments and banks. You couldn't create debt out of thin air because you were limited by the gold you possessed. The Nixon shock ended that. It ushered in the age of pure fiat currency. Money was no longer a claim on gold. It was a claim on nothing but the full faith and credit of the government that issued it. Suddenly, the only limit to debt creation was political will. And the political will has always been to create more. Then came the great deregulation wave of the late 20th century. Rules designed after the Great Depression to limit risk-taking, like the Glass-Steagall Act, were systematically dismantled. This unleashed a frenzy of financial engineering. Investment banks created complex derivatives and securitization models designed to multiply leverage, hide risk, and generate enormous fees. But the true hyperacceleration began after the 2008 financial crisis. To prevent a total collapse, central banks deployed a policy they called quantitative easing, or QE. It was a sanitized term for the largest monetary experiment in human history. Central banks, led by the U.S. Federal Reserve, digitally printed trillions of dollars and used them to buy government bonds and toxic mortgage-backed securities from commercial banks. This had two immediate effects. It flooded the system with liquidity and, more importantly, it crushed interest rates to zero. For more than a decade, money was essentially free. This was a clear signal from the authorities. Borrow, and everyone did. Governments borrowed to fund ever larger deficits. Corporations borrowed not to invest in new factories, but to buy back their own stock, artificially boosting executive bonuses and share prices. Households took on record mortgage and consumer debt, chasing inflated asset prices. This created a perverse feedback loop, a pattern that has defined the last 2 decades. Every crisis has been met with the same solution: more debt. The dot-com bust of 2000 was solved by Alan Greenspan's low interest rates, which directly inflated the housing bubble that burst in 2008. The 2008 crash was solved by Ben Bernanke's zero interest rates and QE, which inflated the everything bubble we face today. Each bailout guaranteed that the next crisis would be bigger. Each intervention created moral hazard, teaching Wall Street that there were no consequences for reckless behavior. The central bank would always be there to print more money. They weren't solving the problem. They were compounding it, guaranteeing that the final reckoning would be catastrophic. This $300 trillion monster wasn't born from a single crisis. It was engineered. It's the inevitable output of a global financial machine designed for one purpose: perpetual expansion. The machine has 3 core components. The first is fractional reserve banking, the financial alchemy that allows banks to create money from nothing. A bank takes a deposit, keeps a small fraction, and loans out the rest. That loan becomes a new deposit somewhere else, and the cycle repeats, multiplying the initial deposit into a much larger mountain of debt-based money. But this system was supercharged by the second component, the shadow banking system. This is a vast unregulated world of hedge funds, private equity, and complex financial vehicles that operate outside the rules. They created the third and most explosive component, the derivatives market. With a notional value exceeding $1 quadrillion, derivatives are bets layered on top of other bets. They are claims on assets that don't even need to exist, creating phantom leverage that connects every corner of the global system in a web of hidden counterparty risk. This is how a mortgage default in Ohio can trigger a banking crisis in Germany. These mechanisms don't operate in a vacuum. They are fueled by a perverse set of incentives, a hidden pattern that traps every actor in the system. Governments borrow to fund social programs and military spending without raising taxes, kicking the can down the road to win the next election. Corporations, fueled by cheap credit from central banks, borrow not to innovate, but to buy back their own stock, artificially inflating share prices and executive bonuses. And individuals are encouraged to borrow for everything, from homes they can't afford to educations that don't guarantee a return. chasing a dream built on a foundation of debt. This creates the final stage, the debt trap. The system becomes so saturated with leverage that new debt is required simply to service the interest on existing debt. Economic growth can no longer keep pace with the exponential growth of these obligations. The machine is no longer building anything. It's just consuming its own future to stay alive for one more day. It's an unsustainable feedback loop, a Ponzi scheme on a global scale, and the engine is now sputtering, threatening to seize up entirely. This $300 trillion isn't just a number on a spreadsheet. It's a global chain reaction, a silent contagion that has already infected every corner of the economy. The first symptom is the persistent inflation you feel every day. This isn't a temporary supply chain issue. It's a permanent feature of a system that must constantly create new money just to keep from collapsing under its own weight. This is a hidden tax on your savings, a slow-motion transfer of wealth from the prudent to the indebted. While your cash loses value, borrowers pay back their loans with cheaper, devalued currency. Savers are systematically punished. Borrowers are systematically rewarded. This debt has also created an entire ecosystem of economic zombies. Thousands of zombie companies that are technically bankrupt are kept alive on a drip feed of cheap credit. They don't innovate. They don't grow. They simply consume capital that could be used by healthy, productive businesses. They are a dead weight on the economy, preventing the creative destruction necessary for real progress. Meanwhile, the central banks, the supposed masters of this system, are trapped. They see the inflation, but they cannot raise interest rates to meaningful levels. Doing so would trigger a catastrophic wave of defaults across governments, corporations, and households. It would detonate the very bomb they spent decades building. Their primary tool is useless. They are prisoners of their own creation. This leaves the entire global financial system exquisitely fragile. It's a house of cards waiting for a slight breeze. Every component is so tightly interconnected that a failure in one obscure corner, like commercial real estate debt or a sovereign bond crisis, can cascade into a global meltdown. This economic fragility inevitably spills over into social and geopolitical instability. When a population sees its savings wiped out and its future mortgaged, anger follows. Inequality explodes, as those with hard assets see their net worth skyrocket, while wage earners fall further behind. This is the fertile ground for political extremism and conflict. It's a pattern as old as civilization itself. Great powers don't just collapse from external threats. They rot from within, crushed under the weight of unpayable debts, just before the final violent unwinding begins. So if the problem is this massive, why don't they just fix it? Why don't central banks and governments solve it? The answer is the most terrifying part of this entire story. They can't. The $300 trillion problem is a Gordian knot, an impossible puzzle with no solution. Any attempt to cut the knot unleashes a catastrophe. This isn't incompetence, it's a trap, and we are all in it. First, consider the political barrier. Politicians operate on 2 to 4 year election cycles. Any real solution, like massive government spending cuts or significant tax hikes, requires immediate and widespread economic pain. This is political suicide. No democratic leader will vote to intentionally trigger a depression to solve a problem that might explode on someone else's watch. They will always choose the easy path. More borrowing, more stimulus, more printing. It's not a conspiracy. It's simple incentive. They kick the can down the road, but the road is running out. There's also no global consensus. Who takes the pain first? The United States, China, Europe. The blame game ensures that no coordinated action is ever taken. Then there is the economic impossibility. The system is trapped between 2 choices, both leading to collapse. The first option is actually paying down the debt. This sounds responsible, but in practice, it means a deflationary depression worse than the 1930s. Governments would slash services, corporations would fire millions to pay down loans, and households would stop spending. The entire global economy would grind to a halt. The second option is raising interest rates to normal levels, the traditional cure for financial excess. But with $300 trillion of debt, this is a death sentence. A simple hike from 2% to 5% would add trillions in annual interest payments globally. Governments would default. Zombie corporations would instantly go bankrupt. The global financial system would implode in a cascade of defaults that would make 2008 look like a minor tremor. Finally, there's the social barrier, the ultimate checkmate. The last century has built a society dependent on ever-expanding credit. We've been promised that our homes will always increase in value, our pensions will be secure, and our governments will always be there to bail us out. Any attempt to impose the necessary pain, the austerity required to deal with this debt, would be met with a furious populist backlash. We saw riots in Greece over minor pension cuts. Imagine that on a global scale. The social fabric would tear apart. No government could survive it. So the trap is set. We need more and more debt just to service the old debt. To stop borrowing is to trigger a depression. To raise interest rates is to trigger a default crisis. And the public will never accept the pain required for any real solution. This is why there is no escape. The system is locked into a path of either continued, frantic debt accumulation until it hyperinflates away, or a sudden, uncontrolled, and catastrophic unwinding. There is no third option. There is no soft landing. So where does this lead? We are entering uncharted territory. The patterns of the past provide a map, but the scale of this problem is without precedent. The $300 trillion Gordian knot will not be untied. It will be severed. There are several potential paths forward, and none of them are painless. The first is a slow, managed decline into stagflation. Think of it as the Japanification of the entire Western world. For years, or even decades, growth stagnates while inflation remains stubbornly high. Zombie companies are kept alive on credit life support, and living standards slowly erode in a silent depression. This is the slow bleed scenario. Politically palatable, because it avoids a sudden shock. The second path is a sudden sovereign debt crisis. This is the Lehman moment on a national scale. A major country, perhaps in Europe or even Japan, fails to roll over its debt. Confidence evaporates overnight. The resulting contagion triggers a cascading financial collapse across the globe, as interconnected credit markets freeze solid. This is the rapid, uncontrolled demolition of the system. A third possibility is hyperinflation. This is the endgame for governments trapped by debt they can never repay. Facing a choice between default and printing, they will always choose to print. They will attempt to inflate the debt away, effectively defaulting on their obligations by destroying the value of their own currency. This path transfers wealth from savers to the state on an epic scale, ending in a total collapse of the fiat money system itself. The exact trigger remains unknown. It could be a major bank failure, a geopolitical shock, or simply the moment markets lose faith in central banks' ability to control the situation. But while the timing is uncertain, the underlying dynamics are not. The mathematical certainty points towards an inevitable, painful reckoning. The patterns of past bubbles and busts are repeating, but this time the scale is global, and there is nowhere left to hide. So, what is the takeaway from this looming shadow of $300 trillion? It is this: the problem is real. It is mathematically inescapable, and it has no politically viable solution. Every path forward, from austerity to inflation, involves a level of economic pain that society is unwilling to accept. This is the Gordian knot of modern finance. But this knowledge is not meant to paralyze you with fear. It is designed to arm you with understanding. This isn't a recommendation to buy gold or short the market. It is a call to recognize the fundamental patterns at play. The purpose is to prepare you mentally for the profound economic shifts that must occur when a system built on infinite expansion confronts finite limits. Mainstream narratives will continue to sell the illusion of control and stability. They will dismiss these warnings as fringe theories, right up until the moment of crisis. Your task is to look beyond those narratives, to understand the hidden truths of a system drowning in its own claims on the future. This awareness is not about predicting the exact day of the collapse, but about understanding the inevitable destination.